The topic, whole life insurance, understanding the cash value. We're going to cover a lot this evening. We're going to go through detailed notes and then also a lot of illustrations. And the goal of this evening's presentation is really to help you understand how the cash value works, but also how you could use it personally. This can apply to you if you already have a whole life insurance policy or if you're considering getting one. So we're going to consider 4 points here, 3 main points, and then a bonus. The points are as follows. Number 1, how do I get the most cash value in a whole life insurance policy? This is where I like to encourage everyone to start. Number 2, what are the actual returns on my cash value in a life insurance policy? Have you ever heard you have a dividend rate of 6% and then thought, my money must be growing by 6%. Is that how it actually works? We'll answer that question directly. Can I fund a policy with a lump sum of money? A lot of people are interested in this if they don't want to make payments for a long period of time. And then a bonus, what do people do if they don't qualify for life insurance? So we'll have some fun. Before we get into the details though, for those of you watching that I have not met yet, a little bit about me first. So hello, my name's Steve. Nice to meet you. That is a picture of me and my lovely wife, Tara. I am the founder and CEO of IBC Global. In my spare time, I like to teach about 38,000 people all about whole life insurance and how the cash value works, and we have a ton of fun with it. So our company currently serves a little bit more than 3,000 clients, many of which have a 7-figure, 8-figure, and even a 9-figure net worth. And one of our largest clients is a bank. And a focus at our company is really you being the policyholder. We make it a point not to focus on ourselves, as the focus should always be on you, not on us, when it comes to your money. So when it comes to cash value life insurance and teaching more than 38,000 people about it, I promise it's all true. If you'd like to have a conversation about life insurance, I promise I'll do my very best to keep it interesting. Now, before I started IBC Global and started teaching about cash value life insurance, I worked at a firm where I learned a lot about it. So the firm that I worked at is still in existence today. It's referred to as an executive benefits planning firm. And my role was really in the back office, where I got to design policies firsthand for corporations. It was at this firm, though, where I learned specific details about how to maximize the cash value. I got to see firsthand how corporations and also wealthy individuals structure whole life insurance policies, and then how we can copy and paste that model for anyone. And then here's a big one at the bottom: what life insurance companies to choose. Doesn't matter. Can I go with a small or medium-sized company? Or do I want to figure out who the big players are using and copy them? So after learning a lot about life insurance, I decided to go off and start my own company, IBC Global. And this is the building that it all started in. So this was a commercial garage at the time. You could see my office on the far right, and then you could see my ride to work. I took that into work in a suit and tie every single day. Totally kidding. That was not my ride to work, but that was the office. So for years, that was the office. That's what it looked like. And how we built the company, it started out with me and one part-time assistant, where literally I would meet with people over GoToMeeting or Zoom. It's all the same. And I wasn't that good at speaking with individuals or sales. So I would do the same thing we did for corporations. I would just pull up the illustration software, ask what they're interested in with whole life insurance, how they're looking to use it, and they would always express, listen, I'm interested in this life insurance policy because of the cash value component. I want to get as much as possible, and I don't want to be on the hook to make payments forever, which is the exact same thing corporations want. So what we would do is literally just design the policies the exact same way we did for corporations, but for individuals. So for about 3 years, just met with people every single day, and that really helped build the business over time. Now, since then, we're still in that same location. However, you wouldn't recognize the building. We've renovated it a number of times where it's a little bit nicer today. It primarily serves as a recording studio. And then our team's much bigger too. So we're a little bit more than 30 employees, which everyone here in this picture is absolutely fantastic. And they like to have fun with cash value life insurance and their other respective roles. So that's a bit about the company there. I hope you enjoyed that. Let's get on into the topics, shall we? So before we hit on the first point, how do I get the most cash value? I want to provide some information on whole life insurance, which really just begins with the basics. With a life insurance policy, what were those 3 areas? Do you remember? First, we had our premium. Let's put that in red, and we'll just call it P for premium. With a life insurance policy, when you start it, whatever your premium piece is locked in, meaning as we get older, we're not going to see it increase over time. So here's a question. With a whole life insurance policy, how long do you think you have to make payments for? Your whole life? A lot of people think that. You do not. You can stop after 2 years, can stop after 5 years. Maybe you say, hey, I want to go until I am 65 years old, or I don't know what I want to do. Maybe I plan to pay into it for a long time, but I'm going to stop early. It's very easy to set these policies up where they're very flexible. What was the next piece we hit on after the premium? Our death benefit, the actual amount of life insurance. So we'll call this DB, which stands for death benefit. It is a monetary benefit that is paid out upon our death. I don't really like calling it that. I don't like the word death, but it kind of is what it is. So what you'll see with the death benefit is as we fund the policy and as dividends are applied to it, the death benefit will gradually increase. And when we die, it is paid out 100% income tax free. And then lastly, we've got the cash value. So no matter what happens in the economy, the stock market, whatever, you will see that cash value gradually increase over time. And we'll hit on some more bullet points on that around that piece too. But this is always the topic of interest. So when we look at the cash value, some bullet points here. It is a safe place to put money, meaning regardless of what's going on in the stock market, economy, if there's a crash, it does not matter. My cash value will continue to appreciate in value every single year. I remember when I was working at the executive benefits planning firm, we were working with a construction company, and one of the owners of the construction company had 7 personal whole life insurance policies. Now, we were looking to get policies for the corporation, or he was looking to set them up, but about his personal policies, when we said, hey, whole life insurance can work for the corporation, he said, you know, my whole life insurance policies are some of my best performing assets. I've had some of them for almost 30 years now, and with one of them, I pay a $12,000 premium, and the cash value growth is almost $40,000 per year. No matter what happens in the market, economy, it doesn't matter. I see this value continue to go up, and he liked that a lot, just the safety and the peace of mind that came with it. Another bullet point here, this attracts a lot of people. I can access it anytime I want. There's no penalties, nothing like that. And it keeps earning interest when I access it. Kind of like real estate. If you own a home or real estate, if the fair market value of that property appreciates, call it 5% every single year, if you have a mortgage against that property, does that affect the 5% appreciation at all? No. Meaning if you were going to sell that property for $200,000, doesn't matter if there's a loan outstanding or not. If it was worth 100 when you bought it, and then the value went up to 200, that's what you sell it for. Same thing with a life insurance policy, where the value continues to appreciate, even if you access the money through policy loans. And then the third bullet point, tax-free. This attracts a lot of people, especially those who are in higher income tax brackets or expect to be in higher brackets in the future. But if we do everything right, when I say we, I mainly mean the agent, so that'd be me in this case. As long as we follow IRS rules, we can easily access that cash value tax-free anytime. That includes the money we pay in, plus any gains, which obviously is very important. So let's continue on, shall we? We're going to focus on two of these bullet points today, which are the safety and also the tax benefits. So the first thing I want to do is identify what not to do. If you're learning about the cash value and you want a whole life insurance policy for the cash value, we want to know what we should do, but more importantly, we want to know what we should not do. So when it comes to whole life insurance, have you ever heard any of the following? That it is the worst place to put money. If you get a whole life insurance policy, you're going to regret it. It's a ripoff or a scam. Insurance agents make huge commissions. We're going to see a little bit on commissions as we progress through this video. Have you ever heard any of the following, though? A lot of people have. I've heard it before and after being in the industry. How about this? Have you ever heard that banks, corporations, and wealthy families have a lot of whole life insurance or cash value life insurance? Have you ever heard anything like that? Maybe, probably you have, depending on how much research you've done. So, why would corporations put money into cash value life insurance if it's a bad place to put money? Why? Let's play a multiple choice, or let's have a multiple choice quiz. Is it one, because they can afford to be ripped off? Well, that's option A. B, they don't care if they lose money because they're just rolling in it. C, insurance agents are excellent salespeople. Or D, could it actually be a good product? You probably know where I'm going here. The correct answer is D. It's actually a good product. However, it needs to be set up correctly. So let's look at an example here. We're going to look at what's called person A and person B. So here's what we'll look at. We'll start with person A. What do you see here? Well, we see a life insurance illustration, and we see money going toward a couple of different areas. What we've got here is a 35-year-old individual paying $20,000 per year. In fact, let me pull up the illustration first. So I'm not going to go through this entire illustration. We can save that for another time. But here's what I want to hit on. So as we look at this guy, we see what? A 35-year-old individual, very healthy. That's the top health rating. But we see that he is just buying a whole life insurance policy. A $20,000 premium buys him $1.2 million in life insurance. So in this example, he pays $20,000. And what does he have to show for it? Nothing at all. Well, about 700 bucks. The next year, he pays $20,000 again. The cash value starts to build, but it takes a very long time for that to build any real value. Then if we look at person B, which we're going to go back to the Excel workbook, but I just want to show you in the illustration first. We have the same company and product, the same individual. He's paying the same $20,000 per year. But look down here. He pays 20 grand, and his first year cash value is about $17,500 instead of $700. Interesting. His minimum premium is closer to $2,000 per year, not $20,000. I'm going to get into exactly what that means when I say minimum premium. But going back to the simplified version, what do we see in person A? Person A gets a whole life insurance policy. He pays $20,000 per year for 15 years up until the age of 50. What this red box is showing, this is at year 12, is by the 12th year, he's paid 240 grand and finally has more than $240,000 or more than what he's paid in. Look at the prior year, year 11. He's paid in how much? 220, and he has 215, which obviously is less than what he's paid in. So it's not that attractive. So again, that's person A when we look at it. Now we're going to look at the exact same company, the exact same product. For person B, what do we see? Pays the same, $20,000 per year for 15 years. What's the difference though? Well, immediately there's a big difference. $17,500 instead of $700. Which one would you rather have? The red box, 4th year. That's when he breaks even or gets all of his money back. In fact, let's take a look at it this way. So we'll look at the cash value difference, CV difference, which is going to show how much more or less you have in cash value if you're person B compared to person A. It's a big difference, isn't it? We can keep dragging it down. It'll just get larger and larger. And again, this is the exact same company and the exact same product. So going back to that question, have you ever heard that whole life insurance is the worst place to put money? And then have you heard that banks, corporations, and wealthy individuals put money here? We just looked at person A and person B, which demonstrates the same product with the same company, the same person paying the same dollar amount in, but different results. So what do you think is going on here? The agent's showing something different. That's what's to be. That's what we want to be aware of here, because we can get the person B policy. We just have to know what questions to ask before starting the product. If we find out after the fact, it can be very difficult to make an adjustment. So person B is what banks, corporations, and wealthy individuals have. In fact, let's take a look at what these entities and individuals do, shall we? So what we'll look at first are some BOLI examples. BOLI stands for bank-owned life insurance. So we mentioned that one of our largest clients is a bank, which is how we have access to this material, as it is not something that is easy to get. Before we obtained our bank client, I couldn't get access to these illustrations. So this is an illustration from several years ago where a bank was making a $10 million deposit. We see the guaranteed cash value, and then we also see the non-guaranteed cash value, which is based on the current crediting rate. Then we see a different company with a $1 million deposit. Here we go. Very nice. This is with New York Life. There's a $1 million deposit. We see what's guaranteed. There's the cash value, more than what they paid in. And then also what's non-guaranteed, which is based on their current crediting rate. And then we've got another company here with Guardian, another one of the 4 major mutual companies. You can see what's going on here. There's a $1 million deposit, guaranteed, non-guaranteed. What do you notice? Is it anything like person A, where they are cash poor right out of the gates? No, not even close. I want to take a look at a simple example of that. So here's the first purchase the bank that we worked with actually made. So what do you see here? On the left, NYL stands for New York Life. I'm sorry, this was the second purchase they made. $6 million deposit with New York Life. Guardian, $2 million. Mass Mutual, $2 million. Add them all up, $10 million. There is the total cash value and total death benefit for the bank. Now, banks approach it in a different way than individuals do, as banks have regulations and such that they follow. However, the key takeaway from this is If it's me, I'm looking at how cash rich their policy is right out of the gates. So if I'm attracted to cash value life insurance, because I understand that banks put a lot of money here for the cash value, I want to know what the cash value looks like and then know how I can copy it to the closest degree. Make sense? Cool. Next, we've got a law firm. So here's how corporations use it. And I'm going to condense this first. There we go. So what we've got here is an illustration. This is actually 3 illustrations combined of 3 partners at a law firm. And we see that they're funding $850,000 per year. Big dollar amount, right? It is. Now, you think they're committed or on the hook to make that payment every year? They're not. A concern of seeing an $850,000 amount going in, what would your concern be? Even if you have a profitable business and most years you can handle that. You might think, what if we have a bad year? Or what if we end up paying more in taxes or something pops up where we struggle to make that payment? Now what do I do? Here's the minimum. This is what they're billed for every year, $85K, and then they can add additional money toward that paid up additions rider, which accelerates the cash value. We'll talk about that more in a little bit. But what do we see here? They aggressively fund it. Cash value looks very healthy, cash positive, between 3 and 4 years, and then they let the cash value ride. Now, what corporations typically do is not just let it ride. They're going to use the money for opportunities for their business, which makes sense, so they can take loans against it. But here's where it gets pretty cool. So we've got 3 partners here, Jeff, Gary, and John. They're using this to fund a buyout for their retirement. So with law firms, eventually senior partners do retire, and usually when they retire, the firm is going to buy out any equity that they own. So in this case, they're each getting about $2 million in total payouts. Not 2 of them get 2 million, the other gets 1 million. My point is, you see this annual income coming out. I know there's a lot going on here. Main takeaway. In purple is the total dollar amount that's being pulled out of the policy. In blue next to it, down here, shows $5 million. That represents the fact that $5 million in total disbursements came out of this policy. How much did they pay in? Look at this column. Total payments, $4.25 million. They deposited $4.25 million. They pulled out $5 million. After they pulled that $5 million out, how much do they have left? $2.5 million. There's still life insurance, which we can scroll all the way down. But when those partners who received their buyouts already, when they eventually kick the bucket, who gets the life insurance proceeds? The law firm. So what a lot of small businesses and corporations do is set these policies up so they can use the cash value today, fund executives' retirement benefits so I can pay my employees later. It doesn't have to be executives, it can be anyone. And then also recover all of those costs through an income tax-free death benefit. Make sense? All right, I hope it did. So what we want to hit on next is the fact that I don't have to put a huge dollar amount into a policy in order for this to work. So the examples we just looked at showed what? $10 million going in, then $850,000 per year going in. Like, these are big dollar amounts. With that said, remember person A and person B, that showed how much? $20K per year. The same could be true with $5K per year, $10K per year, $20K per year. As long as it's set up correctly, we can have a policy that is maximized for cash value right out of the gates. So the answer is yes, this can be achieved with a lower dollar amount. The awareness that I want to have is that 2 people might be shown the same whole life insurance policy, but it could be completely different. Or I should say, one person can be shown two illustrations from two different agents, even with the same life insurance company, and the results can be completely different. So can I get a whole life insurance policy with the same company, same product, pay the same amount, and have different results? Yes, we can, unfortunately. And that is a big problem in the life insurance industry. So let's hit on a point that we kind of discussed with respect to the premium and PUA piece. So if we go back to this, person A and person B. Person B, where's his money going? He's paying $20K, but we see $2,000 is directed toward the premium, and then $18,000 is directed toward the paid up additions rider. So how does this work? Premium dollars first buy you life insurance, PUA dollars primarily grow cash value. The key point to understand here is whenever we get a whole life insurance policy and cash value is our goal, what we want to do is make sure that we are minimizing the insurance premium as much as we possibly can, and then maximizing the PUA rider in order to maximize the cash value. So if you're interested in a whole life insurance policy for the cash value, the first thing we want to hit on is, how do I get as much cash value as possible? We just hit on that as far as the policy design, premium, and PUA. But here's the most important piece. Remember these two things. First, company choice. I'll always recommend one of the four major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Why they're considered to be the four major mutual companies are a number of reasons. We can look at their company size, their financial ratings, how long they've been in business. All four of them have been in business for more than 160 years. But here's the big thing. They all can provide proof of actual performance, meaning not just dividend history. Dividend history looks like this, by the way. So here's some of Mass Mutual's dividend interest rate history. Starting in 1980, what do we notice? Dividend rate was 8.27%. In the 80s, when interest rates were very high, dividend rates were very high. Post 08, when interest rates came down, what happened? Same thing happened with dividend rates. We see that it came down, down, down. And for 2024, it's 6.10%. Okay. That's Mass Mutual. Here's Guardian. This sheet dates a little bit further back. Starts at 1959. It goes further back than that, but here we see the dividend rate was 3.3%. In the 80s, you see the same trend here. As far as double-digit dividend rates are concerned. And then up here for 2024, you see that the dividend rate is 5.90%. Is that important? Kind of, but not really. Here's really what's important. Actual performance, meaning can the company provide proof that they have delivered with whole life insurance policies? Meaning if you called up any life insurance company and said, hey, I'm interested in a whole life insurance policy for the cash value. Do you have any policies that have delivered at least a 4 or 5% internal rate of return? Use those specific words, internal rate of return. That's going to ask them more so for the average. If you just say returns, they're likely going to try to show you an annual rate of return. It's easier to show a higher number on the annual rate of return than it is on the internal rate of return. We'll look at an example of that a little bit later. But let's look at some historical policies here, shall we? So, number one, this is a nice piece because it shows us what multiple companies have done. And this is from an independent study. It's referred to as a Blease report. And these show policies for a 20-year study period from 1984 through 2004. And up top, we've got your four major mutual companies: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The premiums are all different. Here's what I want to look at though. Here's my actual IRR. And the word actual is important. It doesn't say illustrated, and it does not say hypothetical. We want real results. This is a trap a lot of people fall into, thinking that a policy is going to deliver, and then it doesn't. When we look at our four major mutuals, they're all above 4%, well above 4%. When we look at other companies that were disclosed in this report, they weren't there. Now, it's not to say those are bad companies. I've seen one of them continue to make strive to make improvements out of those three below. However, we still are waiting on getting proof of performance from them. The top example was for a 45-year-old individual. The bottom example is for a 55-year-old individual. But those show some independent, historical, whole life insurance policies from a third party in terms of showing the actual results. Next, we've got some policies that we put in place years ago. A lot going on here. Here's what I'm going to do. So this was a policy that someone started right after my wife and I got married. So here's what he's actually paid in. He started in 2015. For the first 4 years, or I should say in 2015, he paid $150,000. And then he paid $150,000 per year through the fourth year. That's a total of $600,000. And these cash values represent his real results. We pulled these from the annual statements, as we like to track the policy performance of everyone we work with. So what do we see here? The break-even point is between years 3 and 4, meaning by the third year, he's paid a total of how much? 150 times 3 years, 450 grand. He's got 435. By the fourth year, another 150 went in. That's a total of 600 grand, and he had a positive return on cash value. So if we've ever heard it takes 10 to 15 years just to get your money back, here's a real policy that broke even in policy year 4. After the fourth year, he decided to cool off on his payments. I believe he's made one more payment. And then after that, he stopped altogether. So he's at a point where he said, hey, I'm content with how much money I've paid in. I just want to see this cash value ride. I'll use it for opportunities right now. He's used it heavily for real estate. And then in retirement, I want to be able to take income on a tax-free basis. And then here is the annual rate of return as well, as far as what the policy is producing in terms of a net return year over year. So that was a policy started in 2015. Here's a policy that's a bit more recent. There we go. And what we've got here, firstly, on the left, is the original illustration. So he started this policy in 2019. And what do we see here? Well, his original plan was to pay in $120,000 per year. There we go. For 5 years. That gets a total of 600 grand into the policy. This was a policy with Guardian. The dividend rate in 2019, when he started it, was 5.85%. So when you start a whole life insurance policy and you look at that illustration and you see that cash value just cooking over time, that illustration is based on the current dividend rate that that company has. So because he started his policy in 2019 and the dividend rate in 2019 was 5.85%, this particular illustration assumed that a 5.8% dividend would be applied to the policy forever. That doesn't happen because dividend rates do change. However, original illustrations are nice to look at because we can really gauge the policy to see what did it originally project and then what is it actually doing. So the original projection had a break-even point between years 3 and 4. What did it actually do? Let's take a look here. Actual results. First year, spot on. Second year, a little bit less. The column to the far right will show you exactly how much less you have. By the second year, you've got $335 less in cash value than what that original illustration projected. Why? In 2020, the dividend rate came down by 20 basis points. Was 5.85%, came down to 5.65%. Stayed low for a while, then started to trickle back up. Because it's higher now, and where it was when he first started the policy, we notice eventually his policy is going to have more money than what the original illustration projected. But they are very close. He still broke even between years 3 and 4. And what he actually ended up doing was paying in even more money. So he liked it so much because he uses it for real estate transactions. This guy actually works for a bank. And when interest rates went up, he said, hey, can I just borrow against my policy for the same thing I was doing with the bank before? It's like, yeah, of course you can. And that's exactly what he does now because he's got a low fixed interest rate. But he decided to pump another 120 grand in. So the original plan was to pay in 600K, and he ended up funding 720,000 total. He might keep on adding money. He'll make that decision this February, as that is his policy anniversary date. So this section was meant to do what? Demonstrate some of the major mutual companies and the strong historical performance. Meaning when we track real policies, we've seen them deliver. The biggest problem in the life insurance industry, in my opinion, when it comes to life insurance products sold where the cash value is a major topic of interest, is overpromising and under-delivering. I see an illustration that tells me I'm going to have $1 million 20 years down the road, and it ends up having $700,000, and I feel like I was ripped off. Like that happens way too much. Where we've seen that not happen is with those 4 major mutual companies when they're set up for high cash value. So aside from that, how do I decide on the right company? Even if I like a smaller company, 2 things. I look at payment flexibility. So for example, the individual we just looked at, where it could pay 120K per year. Do you think he was billed for 120K every year? He wasn't, and he's still not. He's billed for a little bit more than $12,000 per year. I think it's $13,200, and he can pay up to $120,000 per year. This way, the product does not feel like a burden. I want to be able to pay a lot of money, but I don't want to be on the hook where I feel obligated to pay a lot of money. The other thing is, do I want to pay premiums forever? Or do I only want to pay for a few years? If you like the idea of funding for a shorter period of time, that's very easy to do. Even if you set the policy up to pay for a long time and change your mind after the fact, as long as it's set up properly, we can easily do that. So let's look at a couple different illustrations. We're going to look at someone who says, I want to get a certain dollar amount into this policy, but over different time periods. All right, what we're going to do here is condense this and start with a simple example. So here, we've got a 30-year-old individual paying 10K per year. That's his out of pocket. There's his first year cash value, about 92%. If you're wondering how he got that much cash value in the first year, because that's a cash-rich product, how we did that is we used a product that provides a lot of upfront cash value. The name of the product is called a higher cash value product. So let's take a look at the design of this product as it provides a lot of early cash value. So what do we see here? Let's make this a bit smaller. Okay. So we see the outlay, 10K per year. Up here is the premium piece, $1,200 per year. We've got a small term rider attached, and then we're plowing everything else into PUAs. There's my cash value, 92% right out of the gates, and I pay into this policy for 30 years in this particular example. So he's got a target of $300,000 going into this policy over 30 years at 10K per year. So for him, that is a very low amount based on his situation where he feels, hey, I should be able to do that for the next 30 years no matter what. And I like the idea of getting 300 grand into a life insurance product based on the safety, liquidity, and also the tax advantages that come with the cash value. But then he asks, hey, what if I fund it more aggressively? Can you show me an option with that? So here we've got 30K per year for 10 years. Same out of pocket, but what are we doing here? We're condensing the funding period to 10 years instead of 30. What do we see here? First year cash value, still attractive, just about 90%. Breaks even. Year 4 in this particular example, that's where we're cash positive. After the 10th year, he pays nothing, and the cash value continues to appreciate year over year. We can slap a rate of return on that. It's going to be close to 5% when we look at it per year, not the average, but the annual rate of return. We're going to look at annuals and averages in a little bit. What if he says, okay, I like that. Can I get it in even faster? Here we go. Funding the same 300K, but now over 4 years instead of 10 years. When's the break even? Year 4 in this example. Notice they're all very early. This one's year 4, meaning he's got more money in cash value than what he's paid into the product by year 4. This example is the same. This example is just about there. By year 5, you're cash positive. But they're all designed similarly, where we've got the expenses pushed down to the minimum, and we are stuffing the cash value of the life insurance policy, which is important. So with these examples, same out of pocket, but this is meant to demonstrate different funding periods. And these are different companies and products. On the left, we've got that MassMutual high cash value. In the center, we've got a MassMutual 10-pay, and then on the right, we've got a Guardian product. So, policy design. Here's the second item. Number 1 is company choice. Number 2, follow the numbers, not the noise. This is so important. So many people get caught up in this, where they're told, go with the policy that has a higher base premium. It's like, no, that is not what corporations do. How do I maximize the cash value of a life insurance policy? So we're going to demonstrate this, and let's have some fun here. So with a whole life insurance policy, let's assume you're going to pay $10,000 per year down here in blue. Got it? Cool. Where can your money go? First, we've got the underlying base premium of the life insurance policy. Money can go toward the premium. Premium dollars typically generate 0 or a small percentage of the premium in first year cash value. Sometimes it's 0 for the first and second year. The reason why is because the life insurance company is going to overcharge us for the cost of life insurance upfront. So a way that I like to explain it is that premium dollars, I'll refer to them as insurance expense dollars. They buy me life insurance first, and the cash value is secondary. That's life insurance. That's the base premium. Next, we have what is called a term insurance rider. So adding a term insurance rider to a policy is a very, very cost-effective method to get more life insurance. Now it builds 0 in cash value all years, but gets you a very large death benefit. If you're wondering, why would I add a term rider to a policy? What are the 3 benefits to the cash value of a life insurance policy? Safe place to put money. I can access it anytime, and it's also tax-free. The term rider is a cost-effective way to raise what's called the MEC limit, MEC, which stands for Modified Endowment Contract. The third benefit of the cash value, if we follow IRS rules, I can access it tax-free. So any whole life insurance policy can become classified as what is called a modified endowment contract or MEC. And if that happens to your life insurance policy, here's what happens. The cash value still grows. And as it grows, you don't have to pay any taxes on it. It grows tax deferred. However, if you ever access that cash value with respect to the gains only, not what you paid in, but only the gains, or think of it as the interest that it's accumulated over time, you've got to pay income tax on that, and also a potential 10% penalty tax if you're under the age of 59 and a half. So adding a term insurance rider prevents that from happening. That's often why we add this rider. And then last, we've got what is called a PUA rider, which stands for paid up additions. I like to call this a cash dumping, baby, because it's like dumping cash into my life insurance policy. So the first year, I'm going to see that PUA payment show up in cash value. I should say I'm going to see between 90 and 95% of the PUA payment show up in cash value immediately, but then the policy begins to compound. Typically by the second or third year, I see that all of my PUA payments show up in cash value and some, meaning the interest earned is exceeding the fees. So the PUA rider prioritizes cash value, and it does give you some death benefit, but it is very small compared to the premium and the PUA rider. Does it make sense? Fun stuff. When we go back to the Excel workbook and the illustrations, remember where we hit on the premium piece and the PUA piece? That is the main thing to look at when you're looking at policy design. So, same company, same product, same dollar amount. Want to see something cool here? Here's what typically just makes people go, I didn't know that, with a whole life insurance policy. Ever been in a situation like that? I have. So this is going to be similar to person A and person B, but with one added scenario. So again, this is all the same life insurance company, same product, and same out-of-pocket for this individual. And what we've got here are the illustrations. So here's person A. This is just the $20,000 premium. Here's the second example. Just take note of the first year cash value, $11,977. Then here's the third example, $17,488. I'm just pulling those up so you know that the Excel numbers are not made up. We exported them directly from the illustrations. Okay, so first example, here's what most people are sold. When you look at whole life insurance sales, a little bit more than 90% of life insurance policies sold to the individual consumer market, meaning non-corporate sales, sold like this, just life insurance, where I've got no cash value up front. The agent makes a very large commission, as commissions are primarily paid on the premium, and it's a 100% premium. And this commission here is what we would make by selling this product. So that's where this number came from, just for full transparency. So here, $20,000 paid, all premium, nothing in PUAs. You're out of pocket 20 grand. There's your first year cash value. 700 bucks, breaks even, year 12 down here. It's a long time just to get your money back. Okay, let's make this a little bit better. And what we're going to do here is keep your out of pocket the same, but reduce the premium and put more money into PUAs. So this is better, but I still wouldn't buy it. This gives you some cash value up front. The agent commission is reduced here. Instead of $17,000, now it's about $7,200. And why it's less? Because for you, the consumer, you get the same company and product and you're writing a check for 20 grand per year. The premium piece is 8 grand. And the other 12,000 is going toward PUAs. As a result, we paid in 12 toward PUAs. We have about 12 in cash value the first year. We get our money back by the 7th year. That's where we break even. If we look at it by year 20, which one has the most money? This 40% premium and 60% PUA example, call it a 40-60 split. By age 60, you can see a bigger difference there. You're getting close to 100 grand. Let's look at option C. Same company, same product, same out of pocket, much different results. 20K, premium 2,000, PUA 18,000. Here's what wealthy individuals and corporations are sold. Most cash value up front. What happened as a result of maximizing the cash value? Agent compensation minimized down to $2,300. Why it's reduced so much is because we pushed the premium as low as we could push it. There's the cash value though at 17.5. Break even point is also year 4, where we've paid 80,000 and we have 80,000. And if we look at it over time, what are we going to notice? Well, by the 15th year, this is the only example that has cracked $400,000. 411, the other two have not even hit 390. If we look at by age 60, big difference there, isn't it? Yeah, it's huge. And again, same product, same interest rate, everything's the same, except for we just designed it differently. So this is the big item to be aware of when it comes to setting up a policy the right way, especially if cash value is our goal. So the lesson here, we always recommend going with a life insurance company that can show proof of performance, not just good looking illustrations, but real proof, and they've actually delivered. And then I would also recommend going with a design that gives you between 80 and 90% of your payment in first year cash value and breaks even somewhere between 3 and 5 years. What that means, breaks even between 3 to 5 years, is you're getting your money back no later than 3 to 5 years. Okay, let's continue on. Point 2, what are the actual returns on my cash value? Couple questions. If you have $100,000 in cash value and your guaranteed interest rate is 3%, how much should your money grow by? Well, common sense would tell me that 3% of 100 grand is $3,000. What if you have a dividend rate of 6% and you've got 100 grand in cash value? How much should your money grow by? Common sense would tell me $6,000 because 6% of $100,000 is $6,000. Does it actually work like that though? No, it doesn't. So the above is not true. If you're interested in learning how the returns of a life insurance policy work, throw that above approach out the window. Here's why. Anytime we see a guaranteed interest rate or a dividend interest rate with a whole life insurance policy, here's the takeaway. Always know that this is a gross rate that is applied to your policy after the insurance expenses, which means after the cost of life insurance. And there's costs associated with it forever. When you look at how life insurance companies price the product, the heaviest piece of the costs or the heaviest costs are upfront, but over time, I'm never going to see my policy grow by whatever that dividend interest rate is, which is important to be aware of upfront. So how do I see the actual rate of return on my cash value? Well, let's look at percentages first. We've got 2 definitions here. Annual rate of return, which is what is my money growing by every year? So for example, if you've got money in the S&P 500 and you said, what did I earn last year? That would be your annual return. You're looking at just 1 year of the S&P 500 performance. You can do the exact same thing with a life insurance policy. What about the internal rate of return? This is more of an average return. It's going to consider the timing of each payment too. In fact, let's take a look at it. So when we look at life insurance illustrations, they can look like stereo instructions, and they usually do. However, we can also request what is called the internal rate of return, and even the annual rate of return from life insurance companies. And then we'll see those numbers disclosed to us on their compliant material, which is very nice. So anytime someone does ask for that, we always like to include it. What we can also do, for the sake of simplicity, is look at it on an Excel workbook, which is pretty cool. So let's make this a little bit bigger. There we go. And what I want to look at here, this is the same illustration we just looked at in the PDF, but I just want to walk through the dividend rate. So here we've got a whole life insurance policy. We've got someone looking to pump $2 million into the product. Now, if that seems like a big number, it is. But also, if you take a 0 or 2 off, it's the same thing. As long as the policy is set up the same, we're going to see similar numbers there. So the dividend interest rate is 6.1% with this particular illustration. Okay. Do you ever earn 6.1%? First year, you're paying 500 grand. It's got about 450. That's a loss. So you didn't gain anything in the first year. You lost money because you have less than what you paid in. So first, we've got our annual rate of return. Here's what I always like to look at first and foremost. What are the drawbacks? The upfront hit on the cash value, no matter how well it's designed. I paid in 500 grand. I've got 448. No matter how I try to spin that, that's a loss of a little bit more than 10%. Why it's a loss in the second year, because annual rate of return isolates what my money is growing by every year. Look at the first year, you've got 448, you paid in 500. What is 448 plus 500? That'd be 948. What do you have? 933. It's less than what you paid in. You didn't get your full 500 back. That is why we've got a negative return in the second year. And then beginning the third year, we get our 500 back and some. That's why now we've got a positive annual rate of return. And here we see it tops out very close to 5.25%. So it's performing at a nice rate, but does it ever hit that 6.1%? No, it doesn't. Doesn't matter if we scroll down either. We won't see it hit that number. Then we've got the internal rate of return, which again is more of the average when we look at it. Does that ever hit 6.1%? No. Does not even hit 5%. The reason why is because it's catching up, or it's making up for the first 2 years, those hits. Because we're in negative out of the gates, it's going to take time to actually see a more attractive return here. And you'll also notice the IRR will be out of the red when you break even with a whole life insurance policy, which is nice to be aware of. So looking at the percentages, there's 2 things I would look at, or 2 things I would ask for if I'm working with my agent. What's my annual rate of return? And then what's my internal rate of return? That's if you like to see your growth in percentages. What if you like to see your growth in dollars? Then what? We can do the same thing. What I would ask for is the yearly cash value growth, which is simply how much money did I get from the life insurance company this year? And then my total cash value gain, which is everything above what I paid in. Want to see it? All right. The yearly cash value growth. I want to show you something that we see shown a lot, and I'm not a big fan of it. Look at this column right here. Net annual cash value increase. When you see that column and those words, what does it make you think? Net annual cash value increase. How much my cash value is increasing by. The first year shows $448,000 in change. You paid in $500,000. If you put 500 grand in a bank account and you had 448 in the bank account the next day, would you say that the bank account value grew by 448, or that you lost more than $50,000? You lost money. So the insurance company, I see what they're doing here. A lot of companies do this. prefer to model it a different way. All right, let's look at modeling it a different way. So here we go. We'll do the same thing. Make this a bit bigger. What we've got first is the insurance company growth, which is what we just saw on that illustration, which I'm not a fan of. But then we've got the true yearly cash value growth, which is going to back out our payments. So for example, what do you see here? Year 3, the insurance company growth showed $524,322. The reason why is because year 2, you're at 933, and then year 3, you're at 1.457 million, which it grew by $524,000. 933 plus 524 gives you that 1457. Okay. However, if we subtract the amount of money that you paid into the product, your true net gain for that year would be $24,322. So what we want to do, just scratch that 5 off. Make sense? All right. So we like to isolate the yearly cash value growth by simply seeing what I got from the insurance company. I don't want to include my money because it makes the numbers look better than they actually are. That causes a situation where you think you have something good and someone else says, you think you made all this money? It's like, here's reality. And then you're like, oh, you turned bright red, not fun at all. Nobody likes that. So next, we've got the total cash value gain. We mentioned that this is everything above what you paid into the product. Okay, so year 3, you've paid 1.5 million. You have 1.457 million, which is a loss of $42,386. By the 4th year, you've paid in $2 million. You have $2,009,609. So everything above what you paid in is your gain. See what's going on there? Then you paid nothing in after the 4th year. Cash value kept growing, which made that gain bigger and bigger, which is sweet. That's typically what people are interested in, those we work with at least. So that's often how we like to look at the actual returns, or call it the actual growth of a life insurance policy. Do you remember the third benefit of the cash value? First one was safe. Second one was liquid. I could access it. Third one, tax-free. Tax-free if we follow the IRS rules. Why is that important? If you're in a high tax bracket and you're earning 5% and it's an effective tax-free yield, regardless of what it is, it's a Roth account, doesn't matter, how valuable is that 5% tax-free return? It's very valuable. If you said, hey, I could do better than 5% over here in the stock market, but you have to pay taxes on that, how much do you actually have to earn in the market to get that same 5% after you pay the taxes? If that makes sense. Want to see a cool calculator we use to help people with this? None of this is tax advice, by the way. We'll always work with someone CPA or accountant, but this does help. So here we've got the same illustration, 500K per year for 4 years. Here's what I want to hit on first. Annual rate of return. This is the life insurance net rate of return. This individual is in a 40% tax bracket. So what this is showing is if he earns, look at year 10, 4.91%, that's an equivalent to earning 8.18% in a taxable account. Meaning if he has money in a taxable account and he's in a 40% tax rate, after he pays 40% tax rate on that 8.18% return, he'll be left over with 4.91%. Make sense? So that's the power of tax-free. And then sometimes what we'll hear as a follow-up is how much risk do we need to take on to get these higher returns here that are taxable. Now, I just want to be clear with one thing. When I go through this exercise, my intent is not to say that life insurance is the best thing since sliced bread, although I love it. I have it. It's what generates our business. It's what helps us grow. I am a firm believer in diversification and having our assets in multiple places, not just putting everything into life insurance. I just want to make that clear. All right. Then we've got our internal rate of return, which is the average. Here we go. Same thing with the taxable equivalent. I've actually got to update that, but that is okay. So what we can do here, let's look at this guy. With the tax rate, if we're not in a 40% tax rate, what happens when we lower it? Taxable equivalent goes down. See what's going on here? So the purpose of this calculator is really meant to help someone see what they would have to earn in a different account, also taking into account their tax rate. Hope you enjoyed that piece. I have a lot of fun with that. All right, we are nearing the finish line here, friends. Next, how can I fund a policy with a lump sum? Not how can I. Can I fund a policy with a lump sum? The short answer is yes. A whole life insurance policy does not mean that you have to make premium payments for your whole life. This question still comes up a lot today. I think that it always will come up simply because the name of the product is whole life insurance, which makes me think I have to pay premiums for my whole life. That's what the average consumer thinks. I used to think that. So you do not have to do that. There are products that allow premium payments only for 5 or 10 years. And you can even set it up where you make a lump sum payment just once and never put another penny into it. The next question is, should I make a one-time lump sum payment? So lump sum payments do not always equal the highest cash value, which goes against common sense just when it comes to money and percentages. Quick story about Larry. This is a true story, by the way. So when I met Larry, he was 65 years old. He had always invested in real estate. And I met him back in 2014, when Mass Mutual's dividend rate was 7.1%. So Larry said, hey, what's it look like, Steve, if I just write a check for $1 million and dump it into this whole life insurance policy? I'll start to earn that dividend rate of 7.1% forever, right? You start to get the dividend rate. One, remember, it's a gross rate. But the other thing to be aware of is if you do that with a life insurance policy, you just make a one-time lump sum payment. When the second year rolls around, you're still going to have costs that are associated with that product. And if I don't pay it out of pocket, it's going to come from the cash value. So a one-time lump sum payment often is the least efficient method to maximize the cash value growth. I might want to spread it out over a couple of years. So some factors that can impact whether or not funding a policy with a lump sum makes sense. One, our age. Our health can come into play here too, but primarily it's our age. Typically, the older I am, the more sense it makes to spread out a lump sum payment. So for example, if I am 35 or 40 years old and I've got a lump sum of $1 million, I can easily break that up over 2 years. So I've got $1 million, I can break it up into 2 payments of $500K, and the numbers will look very good. If I have that same $1 million, but I'm 50 years old, I might want to spread it out over 3 years. If I'm 55 to 60 years old, I want to spread it out over 4 years. If I'm above 65, I'm going to look at spreading it out over 4 to 5 years. The older I get, the longer I want to spread that lump sum out. Another question to ask here is, do we want to keep making payments after we add that lump sum into the policy? Let's look at 2 examples here, shall we? So first, we're going to look at a 44-year-old who's got a large lump sum. So he was looking to shift $4 million into a high cash value life insurance policy. He's a high net worth individual. And let's take a look at a lump sum option. It wasn't just a one-time lump sum, boom, done. Here's what we looked at. On the left, what do you notice here? You've got 4 equal payments of $1 million per year. Break-even point between years 4 and 5. This is the product that is not super cash rich up front, but long-term has a nice internal rate of return. That's why he was attracted to it. Compared to the exact same product, 2.5 million upfront though. So a big old lump sum, then taking his foot off the gas with respect to the yearly payments. 500K per year through the 4th year, break-even point, just about year 4. If we ran that at the top health rating, probably would be year 4, but he's just about there. Which one has more money? This might help. There we go. So this shows the cash value difference. Now I wouldn't look at the first year because we've paid more into this option. Let's look at it starting in year 4, because now we've paid the same $4 million into each. We've got more with the lump sum up front. And that happens actually where we have more, but it starts to come down until year 8. And then it starts to go up again. You know why? From looking at this very simple illustration. Look at your death benefit in year 8. That was the earliest we could drop it without triggering that MEC, that taxable event, the modified endowment contract. So when we dropped it, we reduced the expenses. We did the same thing with the example to the left. And then the cash value accelerates in the option to the right. So a big old lump sum up front gives a 44-year-old individual more money. Okay. Next. What about somebody who's a little bit older? So here we've got a 57-year-old real estate investor who's got a lump sum of $500,000 up front, and then he wants to pay $100K per year through year 10. You've got a $500K deposit in the first year. He's starting at 57 years old. First year cash value is rich. He's over 90%. Right? He's 471 in the first year. A big thing for him, because he invests in real estate, is, hey, I might want to use this right away. So I do value the opportunity cost of getting in there quickly. Break-even point, year 4 in this particular case. He's not billed for 100K per year either. His minimum is close to 20K in this example. So looks good there, but what does it look like if he breaks it up? So look at the 3rd year. How much has he paid in so far? 700K. Keep that number in mind. What we did over here was fund 250, 250, then 200 in the 3rd year. And the reason why is because we get the same 700,000 in. Now we've got the same company, same product, same out of pocket for him. But what do we see with the cash value? In the 3rd year, we've got less than the example to the left. What about the 4th year? It's different, isn't it? We see that we have more in the example where we didn't add the full lump sum up front, where we spread it out over 2 years instead. Why? By spreading the lump sum out over 2 years, we need less life insurance because we don't need a super high MEC limit. By having a lesser amount of life insurance, we have a lesser cost. That's why we have more money beginning the 4th year in this example. So for him, spreading a lump sum payment out over 2 to 3 years yielded him more money. So here we've got someone that wants to use the capital, put it to work in the marketplace, wants to do it up front, but then sees that it doesn't make sense. Now for him, what he can do is actually backdate the policy 6 months. This way he can go with this option and get that initial 500K into the policy within about a 6-month period. So he gets 2 policy payments in over 6 months instead of 12 months, which is nice. So lump sum examples. Those are 2. Quick side note here. If you want to stress test a lump sum policy, what you can do is ask for the guaranteed values. And normally we illustrate this in the software, but we're going to save that for another time. But that is something that's very interesting to look at when we're looking at a lump sum illustration. And then lastly, we've got the bonus here. So we don't have any visuals for this, but it is a common question that pops up. What if I don't qualify for life insurance? I want a whole life insurance policy. I want the cash value, but I can't get it because I've got a health issue, or I had a health issue in the past. I'm getting over it, but right now I'm uninsurable. First thing to be aware of, the policy owner has complete control of making payments, taking loans, assigning beneficiaries. The cash value is theirs. In short, they have control of everything. So what this means is if someone is uninsurable, they can get a policy on a family member, business associate, or anyone with what is called an insurable interest, meaning you can say to an insurance company, I can't get life insurance. I'm putting it on them because if they die, there is a financial loss to me, my family, or my business, a way we can justify the insurance. And that's something that if you say, hey, I'm not sure if I have that, we'll always talk through it with you to see here are things that the insurance company considers insurable interest. If we don't have it, we'll have to look for another avenue, but we do need that to get a policy on someone else. The most common is getting a policy on a spouse or a child, for example. Sometimes grandchildren, but these are the 2 most common. So a lot of material we covered this evening. I hope you enjoyed it. So to recap, do you better understand how the cash value works in a whole life insurance policy? Do you understand, number 1, how you can get the most cash value by reducing that premium and stuffing the PUA rider? We want that 10% minimum premium. Can you tell how to see the actual returns of a cash value life insurance policy? Do you see how you can fund a life insurance policy with a one-time lump sum? And then lastly, do you see what you can do if you don't qualify for life insurance? Or you know someone who really wants to get a policy, but they don't qualify because of their health. So if you'd like to learn more, feel free to reach out to us anytime. You can book a meeting by using the link in the description. You can also reach out to us direct. I'm going to pull up our company information in a moment here, but I just want to end by saying I do hope that this was helpful. I know the focus this evening was all around whole life insurance and how to maximize the cash value. A little bit more about our company. We focus presently on whole life insurance, annuities, and a couple other products, but the main focus are these 2 right now. We started in whole life insurance as that was my background. We do have some other videos and recent webinars we held around annuities. If you've got questions about how those work and how to make sure we set them up correctly, because if we don't, like whole life insurance, we could have buyer's remorse. But regardless of the product and solution, really what we're always trying to do with everyone we work with is provide transparency and make the best products available to everyone, not just the 1% in corporations. So we've got our contact information below. You can visit our website directly, ibcglobalinc.com. You can email me or the info account, which you'll see on the website, or you can give us a ring. So with that said, I do hope that you enjoyed the session this evening. What we're going to do next is open the floor for a private...